Hello everyone, welcome to Optiongig. This is your host Vivek Somani. I am an option trader by passion and a full-time software executive by profession. If you want to learn how to generate consistent monthly income trading options while working full-time in your day job, then join me in this journey. Alright, today we're gonna cover volatility and its variants. This is a little advanced topic, but I think this is very important for option sellers to understand very clearly on how volatility works. It is because volatility provides an edge to option sellers. So having a complete and good understanding of volatility is essential for long-term success in option selling. Alright, so what we're going to cover today is what is volatility? What are the different expressions of volatility or different types of volatility? We'll talk about implied volatility, actual volatility, and historical volatility. And lastly, we will also cover what are the multiple form factors of implied volatility itself. What are the different ways in which the implied volatility can be expressed? Like I said, this is a little advanced topic, but stay with me throughout this whole session. Hopefully, I'll be able to clarify all these details so that you have enough clarity and complete awareness of the various types of volatility and how to use it. Okay, what is volatility? Volatility is a term that is used to express the amount of movement in the stock. For example, if the stock price moves a lot, then its volatility is high. If the stock is relatively stable, then the volatility is considered to be low. Let's take an example. Let's say if the stock like Tesla is prone to large movements up or down. Please remember, volatility does not tell us the direction of the movement of the stock price. It only talks about the magnitude of the movement of the stock price. So for stock like Tesla will move 30, 40, $50 per day, its volatility is considered to be high as compared to equally priced stock which moves only $5 to $10 per day. So that stock will be low volatile stock. Tesla will be high volatile stock. So that's volatility is just used to express the magnitude of the movement in stock. Okay. Now let's look at what is an implied volatility. When in a trader's trading terms we talk of implied volatility, that means how much a stock is implied or expected to move over a period of 1 year. This is the expectation of the market as a whole of the stock price movement. Like I said earlier, it does not tell whether the stock is going to go up or stock is going to go down, but it just says that the stock will move so much. What is the realized volatility? Realized volatility is the actual movement of a stock over the period of time. Going back, the implied volatility was an expected movement, what the market was expecting, what the traders were expecting. Realized volatility is the actual movement of the stock over a period of time. What historical volatility is the realized volatility over the historical time period. For example, if somebody asks you what's the historical volatility of a particular stock in the month of September, we look at what's the actual volatility and tell that this is the historical volatility over these days. So it's just the realized or actual volatility expressed over a period of time. I hope that makes it clear. Alright, let's jump on to a very important, and I think this is where most of the traders focus on, is an implied volatility. It is because as an option sellers, the edge lies in an overstatement of implied volatility. But implied volatility itself can be expressed in a different form factors. One is the plain implied volatility, that is plain IV, or it is an IV rank, or it could be an IV percentile. So we'll go through each one of these one by one. First, implied volatility. This is an absolute value of the implied volatility. For example, if the IV of the stock is 25%, that means the stock is expected to move plus or minus 25% of the current price over a period of 1 year. Okay, I'll repeat. Hopefully it's make it clear. If the implied volatility of a stock is 25%, that means the stock is expected to move either up or down 25% of the current price at the end of 1 year. This is a implied volatility. It is expected to move. Implied volatility rank. Why it is important? Because the absolute value of IV or implied volatility does not tell if the today's IV is high or low as compared to the historic IV. So as an option seller, our edge is lying in selling options when the IV is high. But if I only focus on just the pure IV number, I will not know if that IV number for this stock is high as compared to where the general IV number is, or it is low. So the absolute value does not tell us that. So what do? We use IV rank. IV rank will tell us where the current IV ranks as compared to is yearly high and the yearly low IV values. So once you know your high mark and the low mark, then you can come to know what is the current IV. Is it really high for the stock, or is it really at a lower end of the stock of the IV? Let's take an example. Let's say the current IV, that the absolute value of IV is 40. The highest IV over past 1 year has been 80 and the lowest IV has been 20. In this case, the IV rank is, if you see the formula, you can calculate it is the current IV minus 52 weeks of low IV divided by 52 week of high IV minus 52 week of low IV. So that turns out to be 33. So it means the current IV is at 33 level, considering 100 is the highest and 0 is the lowest as compared to last 1 year. Hopefully it made it clear. Let's move on to the next one, which is IV percentile. IV percentile will tell us the percentage of days over the past year when the IV has been below the current IV. An IV percentile helps to weed out a single day outliers in the IV. Okay, I'll try to explain it with an example. In the IV rank, two important factors are the highest IV and the lowest IV over a period of 1 year. Let's say something happened on one particular day on that stock. Maybe there was an SEC investigation announced and the IV just shot up to 90 for just 1 day. That was an outlier move for that particular stock, but it will impact IV rank because now the highest level is 90. Well, let's say that IV level of 90 has been there only for just 1 day, and normally the stock's highest level has been just 60. The IV rank will get impacted. Now to negate or to weed out these outlier moves, we focus on IV percentile. It means if I tell that today the IV percentile of a stock is 40, it means over the last 1 year, only 40% of the time the IV of the stock has been below the current IV. So IV percentile of 40 is not really enticing me as an option seller to sell options, because 60% of the time the IV has been higher over the past 1 year. So I would expect that going forwards there is more chance of IV increasing than decreasing. So I would rather sell an option when the IV percentile is much higher than 50. Now IV rank as well as IV percentile both gives us the comparative value of IV. So the question which always comes is, should we use IV rank or should we use IV percentile? In my opinion, either will work, but as a trader you should be consistent. you should know how each one is calculated and be aware of any outlier moves that might have impacted IV rank. I use a combination of both. Mostly I depend on IV rank, but I have used IV percentile also uh, for some time. I think the most important thing to learn is no IV rank, no IV percentile, understand how it is calculated, but make your trade decision based on the premium received and the return on capital. I think that is more important. Sell options when either IV rank or IV percentile is high, and check on how much is the premium you're getting and how much is the return on capital. Hopefully this was useful for you. Thank you for your time. If you have any questions, please write it in comments or email it to optiongig@gmail.com. If you liked what you learned, please help us spread the word so others can also benefit from it. Thank you.